Welcome to TheoTrade. This is Don Kaufman. It's March 11th, 2020, and risk just continues to rear its ugly head inside of this marketplace. Wow, you thought Monday was bad, but there is just follow-through sell-side activity. I got to tell you, there are some just really striking aspects to some of the sell side that we are seeing specifically today. I mean, one of the things that really grabbed me today is, I'm sitting here and I'm trying to trade quite actively throughout the course of today's trading session. You can see I've got positions in and around everywhere. But hey, listen, we're seconds after the market has closed, but the spiders are still effectively open. One of the things I wanted to show you, let me freeze the screen really quick over here. Right after, the bid offer spreads got so wide, you could drive a truck through them. And I actually found that several markets today, we got to points where the volatility was hitting hard enough unto which I could not get out of positions. Here's actually a perfect example, specifically inside of Walmart. There's just no bid, no offer. When I say you could drive a truck through it, it's 485 at 810. All the liquidity today, it concentrated into literally a handful of products. Now, this is not necessarily the end-all, be-all. Listen, you can still function in a market like this, and if you can't get out of certain positions, you do what I do. I actually hedged off. What I basically did is I had a negative delta position on, and I'll just take you into this a little bit here. This is a SPY beta-weighted position. If you don't speak market geek, that is fine, but it's a SPY beta-weighted position. Effectively, what it says is I'm short right here, about 820 deltas in the spider. I turned around and actually used the spider, okay, to create a little bit of a long position and actually offset. Why did I do it? Pretty happy with the gain on the day. Okay, we've had another absolutely stellar day. This is not just bearish positions. This is because I'm net long some volatility inside of this marketplace. Closed out also earlier in the trading session from some key positions I've talked about extensively. In fact, some marquee positions. One of them in which I closed out of was none other than Boeing. In fact, I'll start with this over here. If you go to Boeing, I'll cruise over to my account statement. Let's just go back over the last 7 days so we don't have to pull up too much time. And I just wanted to show, now I've rolled some things in Boeing in the last, couple of trading sessions, another credit over here, but I wanted to show you, okay, I am totally out now, totally out of the Boeing position. For those of you that have tuned in, this was a long duration short position. This was not like an overnight thing. This is a long duration. I initiated this trade, okay? Initiated this trade. Now I have to bring it up on a chart just to really display the full Monty of this particular position. It was all the way back here. It was actually in early 2018. I've sustained the position that long because we've said once Boeing goes, the entire marketplace, okay, will crumble and fall apart. And that's precisely what we're seeing. But let's not necessarily talk about some of my own positions. Let's talk about what we see inside of the marketplace. Again, behold, that risk, it just keeps on coming. And for those of you, again, if you've been in market conditions like this before, you'll probably recognize one very key aspect. And that's this, and you can see a couple of gravity points on here, is that, markets, they had, I guess, what we could call a bit of a crash on Monday. But the bottom line with this is, the marketplace, the crash doesn't come in the front end of the risk. It typically comes towards the back end of the risk. The other aspect that's also, when I was saying stuff is kind of striking over here, yeah, we're coming into in and around the lows, right? We're 2735 in the S&Ps. We've only been very slightly lower than that. But the VIX, it just keeps staring, laughing, and accelerating to the upside. The reason I bring up the VIX and talk about the levels that the VIX happens to be at in any major down move in recent history, and we can go back, 10 years, we can go back 20 years, you can go back since the inception of the VIX. The interesting thing, okay, is that the prolonged down move, and this is starting to become a little bit prolonged, all right? We're into what? The third week of what's becoming hideous at this point. In these prolonged down moves, this is not just a flash in a pan anymore, nothing like what we saw in like August of 2015. In a prolonged down move, the volatility typically declines and then the market bottoms. Here, we have volatility still effectively at a high. And that doesn't mean that the market can't bottom. Okay, quite frankly, I'm at the point where I'm screaming oversold. But again, I want to point out a couple things in the S&Ps before I go much more into detail. One of the things inside of the S&P futures that should really resonate with you, if you've not been paying attention to these gravity points, you're just completely missing the boat. All we're doing once again is pinging back and forth from these gravity points. Okay, if you would like to see that in a little bit more detail here, let me actually tune you into it. This is 2811. Down here is 2731. That close enough for you? In the midst of all this volatility, okay, it doesn't make me feel, these are my gravity points, and it doesn't make me feel warm and fuzzy that we're adhering to points that I can actually pull out, because I believe that you have to get hideous. You have to get just downright, break apart, okay, nasty in a marketplace for us to finally capitulate. Now, the other aspect, and I was bringing this up on Monday's video, the volume to me inside of the S&P futures is minimal. The volume out there is it's just not there. And as I was saying a little bit ago, I couldn't exit a couple of the positions that I was in. So I had to look for alternatives, which is hedging off that risk, which is precisely what I did. In any regard, you're taking a look at the volume over here, it's laughable in terms of low, which tells me, people, it still ain't over. Even if we were to bounce and bounce tomorrow, and I want to give this full, clarity here. I can't tell you in this kind of order flow, it's just too deep, it's too wild. I can't tell you if we bounce or not here in the near term. Neither can anybody else. So when it comes to technicals and so forth, forget it. At this point, I hope you recognize it is every man, woman, and child for themselves. Volatility, please, it takes absolutely no prisoners. But I want to show you things that are starting to become rather disconcerting. This is not necessarily that, this is going to cause a sell-off tomorrow or the next day, but this is going to be continued pressure. Let me actually get down to it. One of the first things that's kind of striking on here on the day, low beta. What's low beta mean? Let's actually go over to the utilities. The utilities broke into new lows today. Why is this disconcerting? Well, for me, I look at the bonds, and obviously the bonds, they actually backed off a little bit. Is that a bullish signal? I don't necessarily take that as a bullish signal. I mean, we could actually be flushing out of bonds, okay, because we need to raise capital. Why do I say that? You notice that gold's down? If I see one more commercial on TV promoting that gold is the end-all be-all, well, if it is, how come it's down in an absolutely hideous trading day? Because people liquidate gold when they get margin calls. They liquidate gold to raise cash. They may right now be liquidating some of the bonds to raise cash because they're getting hammered in other positions. But neither here nor there. Okay, bonds are also getting a little bit rich out there. Okay, back over to the XLU. The thing that's bothersome about XLU, you know that the world right now is basically going to zero interest rates. Most of the world is actually already in negative interest rates. The XLU pays 3.3% dividend, but the problem is it has low beta. Why do I pick out low beta? See, low beta has been a buzz term over the last 6 to 7 years in this business because people, they get a little nervous. Mom and pop, mutual funds, they get a little nervous, and what they do is they get promoted to them, the registered investment advisors, the mutual fund managers, the 401k. They say, why don't you go into a low risk fund? Well, the low risk funds, if everybody puts capital in them, become a lot higher risk. This is actually an extraordinary example of it. This is as low beta as it gets, people. I mean, you're talking low beta risk, which actually tells me that there's huge mutual fund redemptions going on over here. It means mom and pop are actually turning around and whacking the 401k. They're selling it. If you're not happy there, why don't you go take a look at XLP? It's the same animal. XLP pays a 3.56 div on a 0.6 beta. It's also really low beta. Got hit by the tune of 5%. So stuff that is, again, supposed to be low risk, bounced. This is consumer staples. It's getting smoked right along with the XLU. The next one on the screen, okay? I don't necessarily have a great answer for the Russell. The Russell is getting decimated. What's bothersome again about this is the Russell's getting hammered in comparison to the Nasdaq, which we're going to cover here. The Russell had its own little crash inside of today's trading session. For those of you unaware, the Russell actually traded down 7% on the button. Except when the Russell traded down 7%, it didn't hit a circuit breaker because there's no circuit breaker in the last 35 minutes of trade. It just kept right on trading. It did bounce itself. All right, I just wanted to throw that out there. The reason I'm actually bothered by the Russell, take a look at it in comparison to the Nasdaq. This doesn't seem right to me. It just doesn't seem right. The Nasdaq, to me, still rather unscathed in this. In fact, I'm going to bring up the QQQ, and I was talking about this on Monday night's video. I'm going to talk about it again because this is what matters right here, right now. Okay, this is why you should be a little bit worried. First of all, I believe that in the utilities, what you're seeing in there is mutual fund redemptions. If that's true, okay, they're going to come for the Nasdaq, and they're going to come for the Nasdaq in a big way. Why? How? Like, how does that occur? First of all, if you take a look at the Nasdaq, it was up this year, is almost 10%. It's now down, okay, just shy of 10%. If you're unaware, also, if you take a look at the spiders, all right, we're official right now. We're pretty much in bear market territory to a T, all right? I mean, I know people are going to get very technical. We were up like what? Right there. We were up 4.3%. We're now down 15.5%. Technically, we've actually hit bear market territory. Okay. The disconcerting area in the Nasdaq is simply this. Okay. I want you to look at underlyings like Apple for just a second. Okay. So we're going to look at stuff like Apple for just a second. And you have to recognize that Apple on a percentage basis, okay, it's down only what? 8%. So you're like, so what? Who cares? Apple's only down 8%. What do you think's about to occur? If you start to sell your mutual funds, what's the number one holding in it? This has nothing to do with liking Apple. This has nothing to do with fundamentals in Apple. It has everything to do with the fact that if people want out, they're going to get out. And when they go out, all the fund managers have to turn around and sell Apple. There's just no question about it. That's what redemptions effectively do. And we might just be at the bleeding edge of that. The other thing that you have to be really concerned with right now is that it's going to start with the oil companies, and it already has. They're cutting dividends. Okay, they're cutting dividends. Now, let's not talk about Apple and its dividend, because I don't necessarily think Apple is going to have its dividend necessarily cut. It's a nominal dividend anyway. Okay, but I want to relate all the different issues that come into play as soon as you get sell-side activity. One of the first things is it's hideous out in the energy sector. Hideous. Another 5% comes off. Occidental cuts their dividend. There's going to be tons. Okay, you cannot rely on the dividend of anything in the energy in the sector, but it's not going to stop there. Other firms, okay, outside of energy are going to feel this impact. So first it's the dividend. Then what? Then we have to talk about stock buybacks. Anybody who's anybody right now, if you're on a board, you got to conserve cash. You got to raise cash, because they all just saw what happened to none other than Boeing. Boeing maxing out their credit lines over here. Why do you think the stock's down right now? $41. It's an 18% drop. Okay, this is Boeing, the one that you were told could never collapse over here. It's down 43% on a year-to-date basis. Absolutely shocking. Okay, there's a lot more of this to come. So they're going to cut the dividends. They're going to clip stock buybacks. Without stock buybacks, okay, and with mutual fund redemptions, we're in a free-for-all. I want to remind you, Apple is $275. Okay, I also want to remind you that Apple, okay, right here at $275, it hasn't even gotten back to what? The levels it was at in early December. It's just December of 2019. Okay, we haven't gotten back to levels of, let's just call it October, like the rest of the marketplace. That's about where the rest of the marketplace is. Apple should maybe be trading like the 220-ish. Things are still holding up rather well. And to me, that is a disconcerting area, of course, of this marketplace. And again, all of these funds over here, maybe they're holding out, but for how long? We are a ticking time bomb, okay, for redemptions. If passive investing, which everybody recognizes passive investing, again, mom and pop, they put money into a 401k, that's a lot of you. But if passive investing is bigger than it ever has been before, and it is by a multiple of almost 5 times, okay, what it was, for example, 10 years ago, if it's bigger than it ever was before, when they start to pull capital out of it, they're going to come for you, Apple. And on any bounce over here, I'm actually going to look for short positions specifically inside of Apple. Again, I want to reiterate, I'm out of a couple of positions. Number one position I'm out of, Boeing. It hit my target. It hit 200. Okay, I'm out. Out of the contest. Another one. I've actually closed half the position now. Caterpillar. Why did I close half a Caterpillar? Well, for the most part, Caterpillar hit 100. Now, if I take a quick glance at the Caterpillar position, here it is. All right. I mean, I'm selling options here for $58. If you missed the Boeing one again, okay, these are options trading for $147 that I sold. $132. It's out of control. I've got an XLU. Okay, XLU risk twists on, the thing's up over 400%. Okay, there are some huge percentage returns in here, but I'm telling you, in terms of volatility, We're not out of it yet. Okay, there's still a lot more to come. And again, you think volatility reared its ugly head today, stick to these gravity points. All right, stick to the gravity points. It's all we have to go off of on an intraday basis. Keep your hands and feet inside of the vehicle. Trade extraordinarily small. Do not go out and extend yourself into big risk trying to buy a bottom over here, because we don't believe we're home there yet. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.